everybody, this is Sean Riley with Riley Real Estate and MassHomesale.com coming at you with this week's Q&A Saturday video. This week we're going to answer the question of what is a wrap mortgage. So a wrap mortgage is a type of seller financing. In our first couple of videos we talked about a couple different types of seller financing, one of which was subject to, which is when you buy a property and you take over the payments on the existing mortgage. As a straight subject to, generally you're paying exactly what the balance is on the loan, or maybe if you're paying slightly more, you just pay that off to somebody. So, simple example, say there is a $100,000 mortgage. You can either buy the property for $100,000 and just take over the payments with no actual additional cash changing hands, or maybe something small like $105,000, so you give the seller $5,000 and then you take over the payments. That's more of a straight subject to. A wrap mortgage is very similar to that, but it's generally used if there is a bigger spread, so if the seller has a lot of equity. So let's say that you still have that $100,000 mortgage, but we agree to pay $200,000 for it, and the seller agrees, just to make life easy, they are going to take the $100,000 back as a seller financed loan. So now you have the original $100,000 mortgage to the bank and a new $100,000 owed to the seller. Now there's a couple ways to do it. You could have the seller take a second mortgage, or what we're talking about here is a wrap mortgage, where basically you get a new mortgage that basically says that this wraps around the old mortgage. So now there's a new payment which covers the original mortgage and the new mortgage, and the old mortgage gets paid, it's just monthly payment, via the larger payment on the wrapped mortgage. So why would somebody do this? Obviously, if the idea is to sell a property that has, with seller financing, that has another mortgage on it, you need to do something along these lines. Again, either straight subject to, where you get the rest in cash, or you take a second mortgage, or in this case do the wrap mortgage. The advantage to doing a wrap mortgage for a buyer is that they can get seller financing, and that they can pay for the equity over time, as opposed to, again, like I said, paying the difference all in cash immediately in form, as a down payment. So that's the biggest advantage. For the seller, similar type advantages where to the other seller financing, where it opens up more potential. They can get a higher price and a bigger pool of people who can actually buy the place. Specifically with a wrap mortgage, one very big advantage for the seller is that now they have something showing they are receiving payments. So, for example, one of the big drawbacks for subject to is that the loan remains in the original seller's name and it's on their credit, which is going to make it harder for them to get loans, especially if they want to get another mortgage, because what they're showing is this big pile of debt that they still have, and these payments that they're still technically responsible for with nothing to offset it. So that's going to screw up your debt ratios and also your income ratios if you go to apply for a mortgage. With a wrap mortgage, you still have the problem with the debt ratios because you still have the other mortgage in your name. So you still have that debt, so you have to contend with that. But you don't have as big a problem with the income ratios, because now, again, let's make it simple. If you have $1,000 payment on your original mortgage, and you're getting $1,000 from the person you sold the property to, so now you have these things offsetting, so it doesn't screw up your ratios. And if you actually have a bit of equity and are getting a larger payment, it helps you even more, because say you have $1,200 that you're getting and only $1,000 going to the bank, now you actually have a net $200. So that's actually an advantage when going for something like this. So it is sort of a way to protect the seller in that regard. Like I said, there's still some disadvantages, and there'll still be some challenges with the debt-to-income ratios, because you still have the actual debt from the old mortgage on your credit. But it does alleviate some of the other problems. So there's a lot of legalities and technicalities and paperwork that need to go into getting all this stuff set up right. But on its most simplest terms, a wrap mortgage, or if you're in a state that does trust deeds, I'm in Massachusetts, we do mortgages, so you'll hear the term wrap mortgage. All-inclusive trust deed is what they, I believe what it's called in states that use trust deeds more commonly than mortgages. The main advantage there, like I said, is the same with any kind of seller financing, where it opens up more pool of buyers and it leads you to potentially getting a better price, because people can save money on their financing costs, so they're willing to pay a little bit more for that advantage. And so, like I said, the drawbacks are similar to all the other types of things where, obviously you don't get all your money right away. People like to have their money right away. That's just a given. Generally, I guess, there are certain times that people do like to spread it out. But in general, people like to get all their money at once. You don't do that. And in terms of the wrap mortgage, similar to a subject to, you do still keep that original mortgage debt in your name and on your credit. So that can be a hindrance in some things, but again, it's still better than going into default and losing the house. So if that's like a consideration, it's better to have somebody paying something and you having this larger debt there, as opposed to you missing payments and having that hurt your credit. So those are the basics of a wrap mortgage. Like I said, there's a lot more legalities and details as there is with most of this stuff, but it is a way for a seller to use seller financing when they have an existing mortgage and are able to get paid for their equity if they have a lot of it in the house beyond the mortgage balance. So, as always, thank you for tuning in. If you have any questions about this subject, please put them in the comments below. If you have other questions that you would like answered, as always, you can put them on our Facebook page, send us something on our Twitter account, or send an email to info@masshomesale.com, or of course you can put something in the comments below here. And I will link to some of those other seller financing videos and some other articles we might have on that stuff. And that's it. So, have a good week, everybody, and I'll see you next week. Thanks. Bye-bye.